Couple of stories from Breakingviews today. Standard Chartered setback isn't a turning point, they say, and why Tesco's mediocre plan may be as good as it gets. Robert Cole is Reuters Breakingviews assistant editor, joins us now. I know you've just got off the phone with Tesco's.
Yeah, sorry, I was a bit late.
Don't worry, we'll come to that in a second. Let's get a quick line on Standard Chartered, though. Peter Tal Larsen says, look, the problems are very specific. This is not a deep-rooted issue with Standard Chartered.
Yeah, it's still a bit of a shock, I think, that, because we like Standard Chartered at Breakingviews. I think a lot of investors like it as well. It has a very strong management team, very strong businesses, some very promising markets. But, a bit of a jolt today when they come out with this really quite bad news. But I think it is important, as Peter says, to put it into the context. There are some really quite specific difficulties in Korea, funnily enough, pointed to by Tesco, which we'll talk about a bit later on as well. I'm not quite sure if they're precisely the same issues, but there seem to be some sort of country-specific one.
It's a regulation thing for Standard Chartered in Korea, isn't it?
Yeah, absolutely. So it's not something you can, immediately ignore and move on, and I think the market reaction shows that. But I think it's also important to recognise those inherent strengths of Standard Chartered, which I referred to before, and that there must be some confidence that it'll manage its way around these kind of things. Emerging markets are volatile. There are bumps in the road, and you have to look at the kind of longer term.
But this is the first time in a decade it's reported
which perhaps is a testament to its strength because it's only had to disappoint us once in that time. Now, clearly, if it's the first in a series of disappointing results, then we will have to eat our words. But I don't think there's enough evidence for us to predict with any confidence that this is the beginning of the end for Standard Chartered.
The question, Robert, is: are you as glass half full on Tesco? You just got off the phone with the finance director. Your piece talks about investors losing patience. What did the FD say when you put that to him?
Well, I was expecting him to be a bit more defensive, actually, than he was. I've looked quite hard at these numbers this morning, and they're only sales numbers for a third quarter. And, there's, I was going to say a lot of red ink. There are a lot of negative numbers there in the UK and overseas. And I couldn't really see, looking at the numbers, really very much good news at all, frankly. And hence, investor patience is, I'm sure, going to be getting pretty thin. Yep. But, Laurie McKelvey, the finance director, was really quite upbeat. Now, of course, he has to be, right? He's the finance director. He's there to sell. But he was saying that while accepting, I think, without actually sort of going on the record about it, that, there wasn't a great deal of promise in these figures. He was saying that he had a great deal of support from investors for the plan that was being put in place, particularly in the UK. They're spending £1 billion refreshing the store. I think it's going to last longer than that, actually. Okay. To refresh the stores, and while they're not coming through in sales figures, that's partly because the market's been very poor, but that his sort of underlying KPI data about customer satisfaction or something is very positive.
It's interesting. Sorry.
So the other thing I was going to point, and okay, so perhaps I'm going from there's no evidence to we have to have the jury out on this campaign, but I think that what's the alternative? If you're not going to try and refresh the stores, are you going to save money? Are you going to try and sort of just get the margin up because that's good? So I don't quite see. I'm not overbold with this. With Tesco by any means, and it really needs to sort of do something quite quickly. But the question is, what could it do any better? So I guess I'm a glass half full.
All right. And just a final comment from speaking with Schroders this morning about this. Remarkable when you look at the Aldis and the Lidls, the real discounters, that they now have 7% market share in this space. That must be scary for Tesco.
Yeah, it is. Although one of the points that was made to me just a few minutes ago on the phone in relation to the growth of the discounters is that Tesco stopped opening new space. Right, but the others have been grabbing new space, and one of the effects is that although the figures are adjusted on a like-for-like basis to try and take that out, there still is a sort of follow-on benefit in years 2 and 3 of opening space, and Tesco's not getting that. The discounters, at least according to Tesco, are.
All right, Robert, many thanks for that. Robert Cole, For more agenda-setting insight, watch our US Breakingviews show every day, 12:30 Eastern, 17:30 GMT. I'm Axel Threlfall. This is Reuters.